We have John Toohey, USAA Investments Vice President of Equity Investments, who will tell investors his main concerns about the market right now. Joel Johnson is Johnson Bernetti President. He has the best ways, he says, to hedge against volatility in the market. And Larry Shover joining us in the pits of the CME. We begin with you, Larry. Another strong day for the Dow, NASDAQ, S&P, and Russell.
You're exactly right. I mean, after bumbling for weeks between 1840 and 1880, we finally punch our way through that upper ends. Right now, cash 1885. It is stunning. And you know what? Sentiment is strikingly higher even from last week as we suffered through that whole momentum dislocation. Traders are pointing to PMIs that were no worse than feared, auto numbers that came out that were pretty darn good, and also the hangover from yesterday's effect with Janet Yellen in Chicago.
So, John Toohey, does all this good news make you excited or a little nervous?
I would say we're excited, but at the same time we're nervous because we think what it's going to keep this bull market going, we think it's going to be all about revenues, and earnings, because we've seen multiples race ahead. What we need to see is earnings and revenue catch up. And to use an analogy from the auto industry, you know, there's increased use of turbochargers and superchargers to power vehicles today. And what we need is something to turbocharge and ideally supercharge revenues.
Supercharge revenues. Well, listen, as we wait on earnings numbers, Joel, I bring it to you. You're concerned about perhaps putting a cone of safety around portfolios to avoid volatility. We do have the VIX at pretty significant lows, though, not showing a lot of stress. What type of volatility are you talking about?
Well, I'm really talking about what we've seen here in the first quarter of this year. We saw two significant scares, if you will, in the market. And, you know, keep in mind, Liz, most of our investors are retired people, and so they're a little adverse to volatility, maybe a little bit more so than a lot of folks that trade the market every day. But, you know, we like blue chip stocks right now. I'm concerned that after 4 great years in the market that we might not have a terrific year this year. And we're just buying blue chips and high-yield bonds, and just trying to really focus on, as John said, earnings. We want to see earnings. We want to see good revenue growth. We want to see solid fundamentals. This was a very tradable market last year. We made a lot of money last year in hot sectors, and I don't know that it's going to be as easy to make money this year.
Well, although, Larry, people are already making money this year. We should mention, by the way, this is not the first time this year we've had a record close in the S&P. 7th record close in the S&P this year. It's the 50th record close in the past 12 months. So people are making money here. People are going ahead. The big question, though, I think John pointed this out, is what happens with revenue? We're coming into another earnings season. We know how devastating this winter was. If we don't see the revenue from these earnings that are going to be coming in, could we see a downturn in the market?
Yeah, I mean, absolutely we could. But on the other hand, I think there's been so many pre-announcements, so many warnings, so many of us lived through this bad winter that it could end up being a positive catalyst to the market, because I think our expectations are so low and the bar has been dropped to the point that we're just going to chalk it up to a bad winter. And also, we have to remember that the fourth quarter of 2013 was very, very hot. So right now we're just cooling a little bit. It could cause us to churn a little bit, make a lot of people nervous, but at the end of the day, it could end up being a positive catalyst, and we'll see starting April the 8th.
Okay, and again, another catalyst would simply be a day above 70 degrees. So we get back to you, John, that the minute the sunshine comes out, people are going to be running to outdoor cafes and perhaps going back to retail stores to spend some money. Why then do you like names that are in areas that don't capitalize on that? I guess Gilead Sciences, Eaton, this is a company that is one of your favorites too, NXP Semiconductors. You also like CVS, but talk about the common thread that goes through all of these picks.
I think, Liz, the common thread is two things. It's sustainable revenue growth combined with strong free cash flow that's used in a shareholder-friendly fashion, buying back shares, but most importantly, increasing dividends.
Joel, I see that you like high-yield bonds right now. Some people call those junk bonds. Why do you like them?
Well, I like them as a buffer in the portfolio. As I said earlier, I don't know if we'll see a huge year in the market this year, and if I can buy an ETF like HYG, which gives me about a 6% yield, and I can use that in combination with good solid blue chip stocks in a portfolio, I feel very good about my prospects this year.
By the way,
And
let me
even
interrupt
if the
for a
market
second. Now,
takes a
the last ticker that you see there, that's the high yield corporate bonds. Again, these are sometimes called junk bonds. They're a little risky. You're not saying put all your money there, but a part of it, yes.
Yeah, absolutely, David. What I'm saying is use that as a buffer. So maybe you have that as a buffer in your portfolio, and the other half or 60% of your portfolio, I like solid blue chip stocks right now. I like them because of what we've seen in the biotech sector, the big rollover that we had and big downturn recently. Some of the hot growth stocks are getting hit. And again, we're just a very defensive investment firm. So if I can buy blue chips, some high yield bonds, collect a nice dividend on those blue chips, I'm pretty happy until we see this market sort of settle out a little bit. I still feel like the market's a little volatile.
A 6% dividend yield is pretty decent there. Larry, I'll get back to you in the pits. One of the things that jumped out at me the past couple of days is how well the transports have performed. And these, of course, are everything from airlines to choo-choos to FedEx to UPS. What is the message that's being sent there?
Well, I think it's just catching up, and we've seen the airlines do very well last year just with the consolidation in the industry, and that's continuing. But we're also seeing growth in industries where people use UPS, FedEx, where they fly on airplanes, et cetera. So it's a good thing for the economy. We are growing, and that's the message that should be brought out to investors, is that when transportations do well, that's typically because people are using transportation. That's a good thing for the economy. That means we are growing.
John, as we continue to watch these GM hearings, do you think there's going to be any blowout besides what's happening at GM? Actually, what's interesting is how GM stock has actually held pretty well. It didn't tank at all today.
Well, GM looks very, very attractive in terms of its product cycle, where it is in rolling out products. So it would have a tailwind right now. It's going to have to go back through like Ford's doing right now and reinvigorate its products. So we like Ford a lot better because Ford doesn't have the overhang of what's going on in front of Congress today in the recall, and it's refreshing its product cycle. And the Ford 150, that vehicle with much more aluminum and much more efficient truck is successful, that will be a huge boon to Ford later this fall.
And we see you're not the only one who likes Ford. It's up over 4.5% today. So a big day for Ford.
Very strong day.
Thanks, gentlemen.
Thanks to John Toohey, Joel Johnson, and Larry Shovers. Thank you so much. It's a